Bank Corp. We're a $12 billion institution headquartered in Michigan and serving the upper Midwest. In 2009, we approved $2.9 billion of loans, and we're very proud to have 2 years in a row been named the #1 SBA lender in Michigan. I'm also a member of the board of directors of the Consumer Bankers Association, and this association for more than 90 years has been the recognized voice on retail banking issues in our industry, including small business lending. Our members collectively hold 2/3 of the industry's total assets. I'm pleased to have the opportunity to appear before you today to discuss the issues surrounding small business and commercial real estate lending. As we seek to continue to move our economy, and indeed our country, back on the path of stability and prudent growth, it's important to seek input and engage in vigorous debate with focus on those who are most able to influence that path. In my positions with Citizens Republic, as well as with the CBA, I see the challenges we face in serving our clients, protecting our depositors, and navigating through the current economic climate. Those problems have been magnified. As a bank, we ask, how much capital is enough? Some would say, in view of the crisis we've experienced, that a bank can never have too much capital. With an uncertain view of the near future, regulators must focus on protecting banks' depositors. The best way to do that is to require banks to hold more capital. Every dollar of capital a bank requires to cover a potential bad loan is a dollar that cannot be lent to a business owner. It is a dollar that cannot help a community recover and grow jobs. It is exactly the holding of more capital that adds to this cycle's length and severity. By holding capital and therefore making fewer loans or actively shrinking a bank's balance sheet to preserve even more capital, businesses cannot grow and hire because their capital access has been restricted. As banks have navigated through this cycle, it is clear that some of the practices of the last decade must be curtailed, and this impacts those businesses seeking to borrow today. In the past, banks competed vigorously for new loan clients. While most banks had strong credit criteria and policies, too often those were overridden to win a deal. In today's environment, we have not loosened nor tightened our standards. We are holding every loan opportunity against those standards. This may feel to a borrower as if a bank is getting more restrictive, when in fact we are following long-established policies. In our markets, we saw some banks close credit lines via letters that clients brought into our branches. We've seen competitors exit industry segments and geographies. For business clients, we look at each borrower discreetly. Based on their plans and forecast, we have tried to size our lines of credit based on their business needs. For example, a long-standing client with a $2 million line of credit that they've never used, we might work with that client to reduce that line of credit to a more reasonable level based on their business plans and forecasts. To some clients, this feels like a significant reduction, but our goal continues to be that we meet our clients' needs and manage our capital requirements. Commercial real estate lending is driven by lower occupancy and lower rents paid by tenants, or on the building side, slower sales that result in lower prices. These factors in turn drive the appraisal of the properties and our ability to lend to the level that we originally thought we could. For example, we have a client that wants to build an office building and it's a $10 million project. Pre-sales did not come through, and those that did were at lower rent rates. Our clients believe the market will come back, but as yet is unwilling to put in additional money to maintain the loan to value that we look for in our credit policy. And this is a typical example for us. Recent changes in proposal have been made that should have a positive impact, and we support the SBA proposals both on the express loans, the 504 program, and the 7A loans because we believe they will help our industry. The ARC loan program was well intended, but it may not be enough to get bankers to use it because it essentially asks